smell hit you first. Burnt coffee beans mixed with tobacco smoke and salt from men's coats, still damp from Thames fog. Edward Lloyd wiped down wooden tables in his cramped coffee house on Tower Street, listening to ship captains argue about cargo lost to pirates off Madagascar. The year was 1688. Lloyd had no idea he was about to invent an industry worth $2 trillion today. A sea captain named William stormed through the door, his face red with more than cold wind. His merchant ship had burned 3 days out of Bristol. Cargo worth 600 pounds, gone. His life savings, gone with it. His reputation, hanging by a thread. William's wife waited in their lodgings near Wapping, pregnant with their second child, unaware that her husband's world had just collapsed off the Welsh coast. In Edward Lloyd's coffee house, men with money sat at corner tables, sipping bitter coffee and watching William's desperation with calculating eyes. They saw risk, they saw profit. Lloyd saw something else entirely. He reached for his quill pen, the same one he used to track shipping news, and wrote the first marine insurance policy in history. The coffee house had just become a bank. Lloyd understood what others missed. Information was currency. Every morning he gathered shipping news from dock workers, captains, and merchants who crowded into his shop. Ships arriving, ships overdue, ships lost to storms, pirates, or foreign wars. He wrote it all down in careful columns, creating the first commercial intelligence network London had ever seen. The regulars knew the rhythm. By 10 each morning, Lloyd would post fresh intelligence on a wooden board near the window. The Merchant Royal, 3 days late from Cadiz. The Fortune's Dream spotted off Dover with damaged rigging. The King's Pride, missing for 6 weeks in Caribbean waters. Each update changed the odds, shifted the money, rewrote someone's future. But Lloyd's genius wasn't just collecting information. It was understanding what information meant. When his correspondent in Amsterdam wrote about harsh winter freezing the harbors, Lloyd knew spring voyages would face delays and higher losses. The coffee shop had become London's first data processing center. The physical space evolved to match the business. Lloyd installed better lighting near the intelligence board. He created seating areas for different types of business. Ship owners sat near windows. Underwriters claimed tables near the fireplace. Brokers paced between both groups, like human bridges connecting supply and demand. The coffee house attracted a specific crowd. Ship owners, merchants, and sailors gathered at Lloyd's because he provided reliable shipping news. But Lloyd noticed something else happening in those smoky corners. Men with spare cash were making private deals with ship owners who needed money up front. A merchant would put up £100 to cover a cargo shipment. If the ship arrived safely, he kept a £10 fee. If it sank, he paid the full loss. The social dynamics created informal hierarchies based on wealth and reputation. New money sat near the door, eager to prove themselves with aggressive bets. Old money claimed the back booths, making careful calculations. Women couldn't enter directly, but their influence permeated every transaction. Wives controlled household budgets. Widows sometimes sent male relatives to make investments on their behalf. These weren't banks or formal businesses. They were individuals betting their personal fortunes on wooden ships in dangerous waters. Lloyd called them underwriters because they literally wrote their names under the amount they were willing to risk. A ship needing 500 pounds of coverage might have 10 different men, each covering 50 pounds. Spread the risk, share the profit. The mechanics were beautifully simple. A merchant would enter with a ship manifest and a desperate look. Lloyd would write the basic details on parchment: destination, cargo value, captain's name. Then came the auction. Underwriters would crowd around, studying the proposal like card players examining a hand. Each man would write his initials next to the amount he'd cover. 50 pounds here, 20 there, 100 from the successful goldsmith who sat in the corner booth every Tuesday. The coffee house hummed with calculation. Men studied Lloyd's shipping reports like stock traders read market data. They learned which captains could navigate storms, which routes avoided pirates, which cargoes were worth the gamble. The regulars developed a shorthand for risk. A ship to the Caribbean carried a higher premium than a run to Amsterdam. A new captain cost more to insure than a veteran. Age of the ship, time of year, political tensions between countries, All these factors went into the price of coverage. Lloyd saw the pattern forming and made a crucial choice. He started charging underwriters a small fee to access his detailed shipping intelligence. Not just arrival dates, but specific information about which ships were seaworthy, which captains were reliable, which ports were dealing with disease outbreaks or political unrest. His coffeehouse became the Google of maritime commerce. Knowledge flowed in, money flowed out, and Lloyd took a cut of every transaction. By 1692, the system had evolved into something resembling modern banking. A merchant planning a voyage to India would visit Lloyd's coffee house with details about his ship, cargo, and route. Lloyd would post the information on a board near the back wall. Underwriters would study the proposal, then write their names and coverage amounts on a piece of paper. The merchant walked out with guaranteed compensation if disaster struck. The underwriters walked out with premium payments and calculated risk. The genius was in the math. Individual underwriters couldn't afford to cover a whole ship, but they could cover pieces. A goldsmith might risk £20 on a voyage to Spain. A successful merchant might put £50 on a Caribbean sugar run. A wealthy nobleman might cover £100 on a shipment of Chinese silk. No single person carried catastrophic risk, but collectively, they could insure any venture. The paperwork grew sophisticated. Early policies were simple one-page agreements. Within 5 years, Lloyd was keeping bound ledgers with standardized forms and detailed terms. Rats eating the cargo? Covered. Pirates stealing it? Covered. War making the destination unreachable? Not covered unless specifically negotiated. Lloyd's role shifted from coffeehouse owner to financial intermediary. He charged merchants to post their insurance needs. He charged underwriters membership fees. He charged brokers commissions. Most importantly, he guaranteed that paperwork was accurate and participants were reliable. Trust was the most valuable commodity, and Lloyd had learned how to sell it. Lloyd expanded his information network beyond London. He hired correspondents in major ports to send weekly reports about ship movements, weather conditions, and local politics that might affect trade. A man named Samuel in Bristol, another called James in Portsmouth. Each earned £5 a year to write letters about which ships looked seaworthy, which captains drank too much, which local wars were making certain routes deadly. This intelligence gave Lloyd's underwriters a massive advantage over competitors. They knew which ships were overdue, which ports were experiencing problems, which trade routes were becoming dangerous. Better information meant better pricing, which meant higher profits. When plague hit Marseille in 1720, Lloyd's correspondents reported it weeks before official channels. His underwriters stopped insuring Mediterranean voyages while competitors were still writing policies at standard rates. The coffeehouse had created something entirely new. Not just insurance, but a market for risk itself. Underwriters competed on price and coverage terms. Merchants shopped around for the best deals. Lloyd provided the infrastructure that made it all possible. His coffeehouse had become the world's first financial marketplace. But success brought problems. By 1696, too much money was chasing too few good risks. Underwriters started accepting marginal voyages they would have rejected years earlier. Ships in poor condition, inexperienced captains, routes through war zones. The premium income looked attractive, but the underlying risks were enormous. Competition drove prices down and standards with them. A voyage that once commanded 15% premium was now being insured for 8%. Underwriters who demanded detailed ship inspections were losing business to competitors who took a merchant's word. The coffeehouse buzzed with easy money and dangerous optimism. Men who had started with careful 20-pound bets were now risking hundreds on ventures they barely understood. The bubble burst in 1702. A particularly harsh winter storm season destroyed dozens of ships in the North Atlantic. Sugar prices collapsed in the Caribbean, making cargo worthless even when it reached port safely. French privateers, emboldened by war with England, captured merchant vessels faster than Lloyd's correspondents could report them missing. The crisis revealed fundamental flaws in the system. Unlike modern insurance companies, individual underwriters had no legal obligation to maintain reserves proportional to their risks. A man might underwrite £1,000 worth of shipping policies while owning only £300 in total assets. When multiple claims hit simultaneously, Simple arithmetic made payment impossible. Captain Henry Morrison arrived at the coffee house on a cold March morning with news that changed everything. His ship had returned from Barbados, but 3 others on the same route had vanished without a trace. The Prosperity, the New Dawn, and the Merchant's Hope. Total insured value, £4,000. Total available assets among their underwriters, perhaps £2,000. The math was brutal and final. The coffee house erupted in angry voices and desperate negotiations. Underwriters tried to form consortiums to pool their remaining assets and pay partial claims. Merchants demanded full compensation as specified in their policies. Ship owners who had lost vessels but received no insurance payments faced complete ruin. Lloyd found himself mediating disputes that had no good solutions, only degrees of catastrophe. Claims poured into the coffee house. Underwriters who had collected modest premiums for years suddenly faced enormous losses. Many couldn't pay. Merchants who thought their cargoes were protected discovered their coverage was worthless. Some underwriters fled London rather than honor their commitments. Others declared bankruptcy. The coffee house fell quiet as trust evaporated. Thomas Wainwright had underwritten 40 different voyages that winter. His share of losses came to £800. His total assets, $300. He packed his belongings one February night and disappeared, leaving behind angry merchants and a coffee house full of men who suddenly understood what counterparty risk meant. When someone promises to pay your losses but can't, the promise becomes worthless paper. Lloyd faced a choice that would define modern insurance. He could walk away from the mess, close the coffee house, and return to serving coffee to dock workers. Or he could create rules that would make the system reliable. He chose to build structure around the chaos. Working with the surviving underwriters, Lloyd established the first formal requirements for marine insurance. Underwriters had to prove they had assets to cover their commitments before they could write policies. They had to post bonds guaranteeing payment even if they personally went bankrupt. They had to follow standardized policy language that eliminated loopholes and confusion. The new rules were harsh but necessary. Want to underwrite shipping risks? Show Lloyd your bank balance, your property deeds, your other investments. Prove you can honor a worst-case scenario. The casual gamblers disappeared. The serious money stayed and thrived under the new structure. Quality replaced quantity as the coffee house rebuilt its reputation one careful transaction at a time. Most importantly, Lloyd created a registration system. Only approved underwriters could operate in his coffee house. Every policy had to be recorded in Lloyd's official books. Disputes would be settled by a committee of senior underwriters, not by expensive court cases. The coffee house had become a regulated marketplace. The Register Society, a committee made up of underwriters, brokers, ship owners, and merchants who associated through Lloyd's Coffee House, formed in 1760. This formal organization created the governance structure that would eventually become Lloyd's of London, still the world's largest insurance marketplace today. The transformation was remarkable. In less than 20 years, Edward Lloyd had turned a simple coffee house into the foundation of modern finance. The principles he established became the template for banks, insurance companies, and investment firms worldwide. The human cost was enormous. William Hartwell, a cloth merchant who started visiting Lloyd's in 1695, lost his house and business when underwriters covering his Amsterdam shipments couldn't pay claims. His wife moved back to her family's farm. His son abandoned university plans for clerk work. 3 generations of wealth vanished because promises made in a coffee house couldn't be kept. Yet the system survived because it solved a problem nothing else could address. International trade required enormous capital with uncertain returns. Lloyd's Coffee House created a mechanism for distributing both opportunity and risk, making ventures possible that would have been impossible for individuals alone. The innovation spread beyond marine insurance. By 1710, underwriters offered fire coverage for London buildings, theft protection for valuable goods, and early life insurance for ship captains. The coffee house had taught London that any risk could be measured, priced, and transferred if the terms were clear and enforcement reliable. The coffee house had solved an ancient problem. For centuries, merchants faced an impossible choice between accepting catastrophic risk or avoiding profitable ventures entirely. Lloyd's system allowed them to transfer that risk to others who were better positioned to handle it. Capital flowed to where it was most needed. Risk flowed to where it could be most efficiently managed. The economy grew because individuals could take calculated chances without betting their entire fortunes. Lloyd died in 1713, but his coffee house had already evolved beyond his control. In 1734, Thomas Jemson founded Lloyd's List, a shipping intelligence paper distributed to major ports worldwide. Information that once lived in a single London coffee house now traveled the globe. The physical location moved as the business outgrew its space. What started as informal conversations over coffee had become a formal marketplace with standardized contracts and global reach. The economic impact extended beyond shipping. Lloyd's proved that financial markets could emerge from simple human needs, then evolve into sophisticated capital systems. Other coffee houses began experimenting with commodity trading and stock transactions. London's financial district grew around these informal gathering places. The social implications were equally profound. Lloyd's created one of England's first business meritocracies. Success depended on understanding risk, not family connections. A goldsmith's apprentice with sharp math skills could outperform a nobleman's son. Information trumped inheritance. The coffee house rewarded competence in ways traditional English society couldn't imagine. The burnt coffee smell that filled Edward Lloyd's shop on Tower Street still lingers in the modern Lloyd's building on Lime Street. Underwriters still sit four abreast at boxes, which strongly resemble coffee house booths of the 17th century. The basic idea hasn't changed. Someone has a risk they can't handle alone. Others have money they're willing to put at stake for the right price, and information determines who wins. Lloyd's Coffee House gave birth to more than marine insurance. It created the concept of financial markets themselves. Stock exchanges, commodity markets, banking systems, venture capital, all of them trace their DNA back to that smoky room where ship owners met men with money, and Edward Lloyd kept track of the details. Every time you buy car insurance, get a mortgage, or invest in a mutual fund, you're participating in a system that started with coffee and conversation in 1688. The principles Lloyd stumbled onto while trying to help desperate sea captains became the invisible foundation of modern capitalism. Risk can be measured, priced, and transferred. Information has monetary value. Trust requires rules and enforcement. Individual catastrophe can become collective opportunity with the right structure and safeguards. But the human drama remains unchanged. Behind every financial innovation are real people facing real problems with limited options and uncertain outcomes. Captain William, who lost his ship in 1688, was no different from a small business owner today who can't get a bank loan, or a homeowner trying to secure flood insurance, or an entrepreneur seeking venture capital. The stakes feel enormous when it's your money, your future, your family's security on the line. Today's financial world would be unrecognizable to Edward Lloyd, but he'd understand the basics immediately. People with money looking for return, people with ideas looking for backing, and someone in the middle keeping track of who owes what to whom. The tools have changed from quill pens to quantum computers, but the human drama remains identical. Greed, fear, hope, and desperation still drive every transaction. The next time you smell fresh coffee brewing, think about Edward Lloyd wiping down tables in 1688, listening to ship captains argue about lost cargo. He wasn't trying to invent modern banking. He was just trying to help his customers solve their problems and make a living in the process. Sometimes the most important innovations happen when you're not trying to change the world, you're just trying to get through the day. The coffee house that became a bank, that became an industry, that became the foundation of global finance. All because one man understood that information plus trust plus rules could turn individual disaster into collective opportunity. What other everyday businesses around you right now are accidentally inventing the future? Hit subscribe to find out how ordinary people in ordinary places created the extraordinary systems that run our world today.